Hengui for Pandemic Lesson Number 1, Normal Economy versus Abnormal Economy, a Crisis Management Analysis. Mr. Lee Hengui is an Executive Director of Socio-Economic Research Center. Mr. Lee had 30 years of professional experience as an economist, with almost 13 years in Bank Negara Malaysia and 19 years within the financial services industry. He was former head of economics of CIMB Investment Bank and has led CIMB macroeconomic research to be ranked top 3 for 9 consecutive years in the Asia Money Polls. He holds a bachelor degree majoring in economics from University of Malaya and a master degree in development economics from Williams College, USA. Please welcome.
Thank you, Amani. Let me pull out the screen. So I hope you can see the screen, right? So can everyone see the screen?
Yes, Mr. Lee.
Okay, good. Thank you. Good morning to everyone. Thank you, Malaysia Financial Planning Council, for having SCRC this morning today to give us opportunity to participate in the 9th FMPCE conference. I think the title for today is talking about normal economy versus abnormal economy, a crisis management analysis with special focus on Malaysia. I think since the Malaysia independence in 1957, I would say over the last 6.5 decades of Malaysia economic development, we had witnessed a few episodes of major economic shocks. And the causes of all these shocks or economic crisis were very different in nature, and it required a different set of policy responses in order to bring Malaysia out of each episode of the crisis. I think in summary, we had witnessed 4 major economic shocks since 1957 as Malaysia independence. The first one was the commodity price shock, happened in 1985 and 86. We saw Malaysia had a mini recession, commodity-induced recession, with of GDP about -1% contracted. And the second episode was the Asian financial crisis, 1997-98. That was due to both the imbalances of the economic and financial crisis, triggered largely by the Tom Yum that happened in Thailand, that caused a major devaluation of the ASEAN currency, in particular Thailand, Korea, Indonesia, and Malaysia, which saw Malaysia economy contracted by close to 7.4%. And the third major crisis is the global financial crisis that happened in 2008 and 2009 due to the subprime happened in the US, the subprime market, and also some of the debt crisis in the Eurozone economy. We saw Malaysian economy contracted by -1.7% in 2009. Now, back to now where we are now, we can see Malaysia again vulnerable to another crisis. And this time the crisis is very different. This is a pandemic crisis. It's a health crisis which encompasses all aspects, not just the economy, financial, social, but also the health aspect. That poses a big challenge for the global, the government in the global economy, but also in particular to Malaysia. And today, I'd like to share with you how we come out from the crisis. Most importantly, I'd like to give some pointer for the government to consider how to rebuild Malaysia into a better, greener, and sustainable economy post the pandemic recovery. So the outline for my presentation today will be divided in 3 sections. One is to show how Malaysia doing post the COVID-19 pandemic, followed by how to invest in the inflationary times in line with the Sharia Council on Investment and Wealth Management. And lastly, to give some pointer for the government, for the policymaker to ponder, to consider how to make Malaysia even better after the pandemic. post-pandemic back to normal or a new normal, abnormal? I think, yes, we are moving up from the pandemic to an endemic. Worldwide, government, including Malaysia, has started the transition. For Malaysia, we started on April 1st this year, and I believe there are still some risks ahead, which we should not take it lightly. Whether the risk will come from the potential new variants of a pandemic, or the risk coming from the shock that coming on all fronts, whether it's a supply shock, the commodity shocks, and also there are some major challenges on the domestic front which the government need to address for making Malaysia better. I think the first thing we have seen, COVID-19 pandemic has disrupted the government, the society, the human and social life, as well as has impacted the business way of doing business in a very unprecedented way. So whatever the induced disruption coming from the pandemic on financial damages has further widened the already income disparity between the rich and poor household, as well as between the regional states, like regional development gap likely to widen between the east and west, for the poor state and the development state. And also now, even though we are slowly recovering from the pandemic, but the economic scarring impact will likely to take some time to completely erase, revive completely. Why? That's the reason the pandemic has impact on the long-term economic, political, social consequences, and that require bold policy options for growth and enhancing Malaysia economic resilience. So as we move out of the pandemic towards a new normal, the government must use this opportune time to implement the right policy for ensuring better, inclusive, greener, and sustainable growth. Let's do a quick rundown of how much Malaysia had put in terms of the size of the economic and financial packages to blunt the deep economic financial damages. In summary, there are altogether seven economic packages and financial assistance totaling 530 billion or equivalent to 36.1% of GDP. This is the ever largest packages that we had since 1957 to counter the impact of the pandemic crisis, health-inflicted crisis on the Malaysian economy. I think in a nutshell, the whole packages, the 7 packages, comprises of various aspects to preserve the people welfare, to support the business, including the SME, and to strengthen the economy. I think the one that really draw attention of all the biggest packages is the EPF withdrawal, which is this compulsory saving by the employee for future retirement, for the pension. But because the limited fiscal space by the government as we enter into the pandemic crisis, the government can only afford a direct fiscal injection, which is highly impossible for them to blunt the damages. Hence, they allow the employee to tap on their retirement savings as a short-term gap measures to ease the impact of the financial economic and health crisis on the household burden. Hence, we saw the 3 rounds of the EPF withdrawal, we had about 110 billion. Without this EPF saving withdrawal, I believe the contraction in the consumer spending will be even much deeper and larger and longer and lasting. And the other impact coming from the financial assistance provided by the banks is the loan repayment moratorium, which total close to about 97.3 billion, which benefit not just the individual borrower, but also the SME and micro enterprises. So in all, the direct fiscal injection is about 87.6 billion, about 6% of GDP. If you compare this to the total size, the 530 billion includes those are not funded from the government fiscal position. So with that, as I mentioned, Malaysia enter into the pandemic crisis with a limited fiscal space, and hence, if you look at since the 97-98 Asian financial crisis, Malaysia budget has incurred 25 consecutive years of fiscal budget. Yeah? Hence, you look at since 2019, our fiscal deficit has widened to close to 6.2% in 2020, 6.5% in 2021, and for this year, it projects to be narrowed to 6%, which I think likely to be a tall order. Most likely, the fiscal deficit will still be quite high, between the 6 to 6.5%. So I think that the message from this side is that Malaysia need to rebuild the fiscal space to safeguard against future shocks. And that coming shock could be even bigger, which require a stronger balance sheet from the government to withstand any disruptive changes and impact coming from whether it's a financial, economic, or health pandemic crisis. So given the continued persistent years of budget deficit, Malaysia has incurred continued rise in the federal government debt and also the liability. This is a contingent liability guaranteed by the federal government given to those government enterprises, whether it's a form of the letter support or whether it's a form of direct guarantee. If you look at the current debt, the government direct debt in terms of total GDP is about 63.5%, is almost closer to the 65% debt ceiling, which was administratively capped and also revised during the 2020 COVID-19 pandemic. And if you plus the contingent liability, the total debt and liability for the country is about 85.2%. It's about 1.3 trillion ringgit. So these are the things that we have to rebuild the fiscal space for future shocks. Now, as we are moving into an endemic from the pandemic phase, Malaysia faces multifaceted shocks. And the shock coming from, in summary, 5 major impacts. The first one, whether due to the previous pandemic supply chain shock, and now with the added onto new shock coming from the Russia-Ukraine war, we saw higher energy and commodity prices. That prices not just cover oil, gas, beef, soya bean, maize, as well as other industrial matter, surge on the supply uncertainty, and given the continued harsh economic sanction imposed by the US and some of the country on Russia, that further worsened the supply chain disruption. Now, second impact will be inflationary pressure. I think globally, we are expected to see higher and longer inflation. And Malaysia is somewhat sheltered by the continued fuel subsidy, but other than fuel, other goods and services, Malaysia also experienced significant price level on the ground. Whether that level, price level, if you reflected by the CPI, is still quite manageable. But if you go down to the ground and buy the goods that you consume, everything has increased easily by 10%. So that will be another concern that we had. The third one is an increasing business cost. Given the rise in the energy, commodity, and raw materials and industrial material, that had continued to cascade price effect on the cost of doing business. And that's particularly painful for the small, medium enterprises and the micro business. And in addition to that, we also see continued high level of logistic costs and shipping rates for those exporters and importers. And the fourth one is the financial market. Given the continued war uncertainty, which is now into the second month and likely to take a longer while to settle, you may further see the concern impact on the global economy recovery. And in general, market is still worried about the global stagflation, risk, high inflation, low growth, as well as concern about recession risk in the US economy on the back of aggressive interest rate tightening by the Fed to control inflation, to keep inflation under control. And that financial market volatility will see investors will flight to safety asset. Suddenly, like bonds, treasury, US treasury bills, gold, and also the hard currency. The fifth one, how the central bank will act to balance the policy needs to support the growth as well as to control inflation. So we see the first move by the US Fed has begun its interest rate normalization journey, has increased the short-term rate by 25 basis points, and market expect more to come. The market expect at least another 6 rounds of successive increase in the short-term Fed rate in order to keep the inflation in check. And other central banks also on high alert. And we have seen for the last 2-3 weeks, some central bank in the region has started to normalize interest rate. And hopefully that will help to control the inflation rate risk without undermining the recovery path of the economy, including the impact on the global economy. And I also like to highlight here, watch out for China economy. China economy, which has slowed down in the second half last year, started the year despite the first quarter number turned out to be slightly better than market, but in general, I think the zero COVID approach in China will have impact on the China economy over the next few quarters. In addition to that, not just the zero COVID approach for China, but also the concern about the debt of the debt deleveraging, as well as the property market, and the need to control excessive investment in unproductive sector that may continue to weigh on the consumer spending as well. So now turning to Malaysia, I believe Malaysia is on the recovery path, but there are risks to growth which remain tilted on the downside. Let's look at this slide. On the yearly basis, Malaysia growth for this year, as projected by the Central Bank of Malaysia, Bank Negara Malaysia, is between 5.3 to 6.3%. And for SCRC, our projections, we are looking about 5.2%. We are taking a more conservative assessment of Malaysian economy until we see a stronger and firmer return of the consumer spending, private investment growth, and also a less risk coming from the external side. So if you look at the quarterly momentum, definitely Malaysia came out from the bottom. In the third quarter of last year, Malaysian economy contracted by 4.5%, but in the last quarter, it rebounded back to 3.6%. And the strength of rebound is still not that strong. So hence, we need to see coming into the first half of this year, how strong is the recovery? And most important, the growth will have to be supported by sustainable private consumption and private investment growth. Based on our SCRC forecast, we expect private consumption to grow by 6.5% compared to 2.6% last year, while investment likely to remain cautious, is likely to grow by 5% versus 1.9%. And the other catalyst for Malaysia recovery will be external sector. Yes, both the export and import growth will continue to grow, but because of the high base effects last year, and we may see the growth will be somewhat moderate compared to last year. And despite we have the good, strong price effect from crude oil and CPO, crude palm oil. So in a summary, I'm looking at cautious optimism as Malaysia transits from the pandemic to endemic phase. As we open the international border, we should expect recovery in the tourism and related services sector. But there are risks. The risk is global monetary tightening that will affect on the financial market volatility, on the liquidity condition in general, trade friction, stagflation risk in some of the advanced economy, climate change impact on the business, on the economy, on the social, and the unpredictable geopolitical tension between the advanced economy, in particular between US and China. Now, for this year, we expect Malaysia domestic demand will continue to underpin, to be the main anchor of growth. Private consumption. Okay, this number, 9%, is a projection by Bank Negara Malaysia of 9%, compared to SCRC, our social center, is 6.5%. I think we agree there are some catalysts will underpin a recovery on consumer spending, pent-up demand, cash handout, and EPF withdrawal. And I think most important, we need to see a sustained recovery income and also the employment rate. The jobless rate for Malaysia now is about 4.1% and still high compared to the pre-pandemic level of 3.3%. And the other concern I had is inflation and high cost of living could dampen consumer sentiment. On the private investment, our estimates are quite in line with the Bank Negara Malaysia. Is between the 5 and 5.3% respectively. I think the concern here is about the increased costs, the manpower shortages, and external uncertainty. Uncertainty will continue to weigh down on the consumer, on the business sentiment. The third one is the public consumption. That is the consumption by the government sector to support the overall economy. Mainly are coming from the emolument, and they expect the supply and services expenditure to contract. So in line with the government to slowly consolidate their budget spending. And the fourth one is the public investment, which is account for 4.5% of GDP. I think the growth will come from the increased government budget spending in transportation, public utility, healthcare, and education. And the export side, as I mentioned, we are expecting a slower real growth of 4.4% versus Bank Negara 4.8%. Compared to last year, it's such a high, strong real export contribution in terms of the demand coming from E&E sector and also improvement in commodity prices and production. And import will be in line with the recovery in domestic economy. And given that Malaysia still depends on intermediate import and also capital goods, that will be the proxy to watch whether the private investment will recover at a stronger pace post the pandemic. And now I'd like to share with you in terms of the sectorial performance. We expect expansion in all economic sectors. The one to watch will be the services sector, which make up 57% of GDP. That thanks to the reopening of the international border, which we hope to see a gradual recovery in tourist arrival. I think the projection by the government, by the Ministry of Tourism, this year they expect about 2 million tourist arrival, and that expected given that it takes some time for the confidence of the tourists to come back, and most importantly, the business operator in the tourism industry or the services industry must give the first priority of continued vigilance on the health standard. Yeah, that's important, and must make the tourists feel safe to stay here and safe to travel and safe to enjoy their stay in Malaysia. I think the thing that I'm looking at this risk is that as long as China still keep a zero COVID approach, and we may see a less return of the tourist arrival in China. And China tourist arrival in Malaysia make up close to 11.9% of the total tourist arrival in year 2019. That's close to 3 to 4 million. So it's a big number. We hope that it can come back, not just for Malaysia, but also for the region ASEAN, and that will spur a lot of inter-country travel and help to ensure a sustained demand for the tourism and also related services. Now, the second sector to watch is the manufacturing sector. It's about 24.3% of GDP, and we expect that will be supported by strong order book in the E&E sector, electronics and electrical product, and some of the growth coming from the construction-related material to support the revival of the construction industry. Now, construction sector is a sector that we are hopeful that it will rebound stronger this year, but there are concerns of the increased prices of building materials could delay, postpone, and stall some of the new project in the pipeline. So this is something that we have to also monitor, whether the continued rise of the building material in addition to the shortage of worker, it could dampen the anticipated recovery in the construction sector. Now, labor markets is gradually recovering. based on the Bank Negara estimate, is about 4%. It's quite in line with the SERC. As I pointed to you, the latest 4.1% in the month of February is still way below to the pre-pandemic of 3.3%. There are reasons for that. I think, first of all, let's look at the whole nature of the unemployment rate, not just the skill-related underemployment, but also time-related underemployment. These are two things that we have to be mindful, that there are a lot of people in the market with the right skill but couldn't get to match the job they want. Okay, so hence they are working below the capacity. Yeah, and also when we talk with some of the business on the ground, because of the shortage of workers, the foreign workers, some of them are still operating below the capacity. And yes, you could say that the business, they can hire the local employee, but some of the works may not be preferred by the local employee, partly because of the wage offer, partly because of the some of the skill set they need, mainly a bit low skill, and these are the 3D jobs, dirty, dangerous, and they may not like, they may want to work in a more comfort type of workplace. So in terms of the revival, how this revived economic activity will strengthen the manpower demand, again depends on the overall strength of the different industry in terms of how they can recover fully, stronger post-pandemic. Hence, they will increase the demand for worker. But we also have to be mindful, given that we are just moving to an endemic, our border just reopened, there are some sectors would require a longer time to recover, in particular the tourism services and maybe the aviation industry. Hence, the pace of demand for worker will be equally uneven. Mindful, before the pandemic, already they have disruption coming from the digital technology that continue to replace the demand, the labor by the digital technology. And also during the pandemic, company realized that a lot of things can still be working on the remote mode, which you may not require the people to go back to office, and you start to look at whether there are either resources, manpower resources, which again call for reorganization of the manpower needs for some industry and some specific skill type of job. So these are things may see a slow, gradual recovery in the employment in the labor market. Now, on headline inflation and core inflation, we expect this year will be higher. It could be longer than expected. Yes, Malaysia inflation forecast by Bank Negara is about 2.2 to 3.2%. Core inflation is 2 to 3%, but SERC is looking even higher, headline of 3 to 3.5%. I think I don't think I need to elaborate further, but the cost pressure are coming from all fronts, from the business side, and that will pass through to the consumer as they cannot absorb the increase in the producer price index. Look at the price paid by the producer manufacturer for the raw materials, whether it's a commodity or non-commodity related, continue to increase a strong double digit and even a single digit high. These are much at a level which I think producer cannot absorb. They may eventually pass through, or some already passed through, and you may see second round of pass-through effect coming should the government decided to reduce the subsidy on fuel prices. So there will be other future driver of cost, whether it's the cost to the consumer and also to the business. These are the carbon tax, which is good as we embrace ESG, as we protect our environment. So a carbon tax will come, and hence the complying of the new regulation would increase of the cost for the business. Again, consumer may have to pay for the better future. Yeah. So export side, we expect exports to normalize to a long-term trend after a very strong performance last year, and this year we expect growth about 5.9%, and Bank Negara number is even higher, 10.9%. I think there's the potential upside risk to this export number, provided the global environment likely to improve further in the second half, because now we are still monitor the continued impact from the Russia and Ukraine war the induced supply shock, the induced cost shocks onto the business, and whether that will hit on the consumer side, inflation, and they may reduce the demand for goods and services, hence will impact on the export side. Even like commodity prices, at high level of commodity prices, I think the buyer will wait and see whether the prices will stay elevated at this level. They don't want to be caught at very high price. At the same time, inventory, they want to manage inventory so that they have a better working capital to buy the inputs for the production to meet the new demand. Okay, so these are the things that we have to watch out. But the good thing here is that RCEP already came into force for Malaysia on 18 March. I think RCEP will be a catalyst to aid the Malaysia exports recovery post-pandemic, given that Malaysia trade with the RCEP members, 14M members, is about close to 60% of total trade, which is about export account for 58%. So there are a lot of potential for us to export to this market, and in particular China and Korea, Japan, with the reduction in tariff over a period of 20 years. And we hope that government will ratify the CPTPP by third quarter of this year. That again provide another route for Malaysia exporter to increase their export share. Now on the loan indicators, loan demand is picking up. This is a good sign. Reflect the confidence that Malaysian economy is on the path of recovering. I think the overall loan growth is about 4.7% in the month of February. And I also give you a perspective on historical from 2018 until now, how the loan growth has been coming down to in line with the assessments of economy, underlying economy conditions. And I think if you look at the household side, the one in the blue color, the growth is at 4.7%. It has improved compared to a very low than 1%, about 3%, 6%. But at the same time, I like to caution that the household debt remain an ongoing concern. Household debt, I think central bank had put in place a lot of measures to contain the rise in household debt, to ensure that the household have the capability to repay the loan they borrow, either for investment, for consumption, and also for other purpose. I think most important, I think we have to make sure that we are not in a situation where household cannot afford to repay their debt and continue to borrow for debt-fueled consumption. That is not a healthy trend. As you know, we also make sure that the household have a better financial planning for their future, and make sure that whatever they earn, their income and the saving is balanced against for the current consumption and also for the current investment needs. Yeah. So if you look at the NPL ratio from 2018, we have seen quite a relatively stable total NPL ratio, even though we see some small uptick in the household side and also some business related. But bear in mind, over the last 2 years, we were sheltered by the loan moratorium assistance program and continuous selective loan moratorium repayment assistance program. So I think the real test will be after March, as we move to the second quarter, see whether some of the borrower, or whether they are individual or business or SME, will they feel any stress in terms of repaying their normal repayment loan schedule. Now, in terms of the disbursement, loan application, loan approval, loan disbursement, and loan repayment, we have started to see some, I would say, a very uneven progress in terms of the monthly average of loan application, approval, and also the disbursement. Yeah. So repayment number will start to likely to show continue higher repayment as the loan repayment assistance end. Yeah. Financial indicator. This is just to give you a perspective how Malaysia financial market perform after the worst impact from the pandemic in 2020. At this moment, the index in general still holding around the 1,005 level. And I think markets still expect a better performance for the economy. Hence, there will be a positive impact on the corporate earnings. I think most important is how resilient the performance of the financial market is a function on how we get out from this pandemic and move on to a more sustainable, inclusive, and more robust type of growth driver, in order to underpin, to support the corporate earnings growth. And that will attract the renewed inflows of the foreign investor to Malaysia capital market. So if you look at the portfolio flows, we suffer sharp net outflows of 48.2 billion in year 2020. That was during the height of the pandemic. So last year, we managed to see a reversal net inflow of 18.9 billion. This was largely underpinned by the continued investor investor holdings of the Malaysia bonds. Okay, and on the long term, FDI, foreign direct investment, we continue to be one of the preferred location for foreign investor to invest in the manufacturing sector, in the services, and mostly in the manufacturing sector. And then we saw a big approval happen in the year last year due to close to I think about $9 billion US investment from Intel and some other related to solar energy, the solar power sector, and also by the China investor. So in terms of the exchange rate performance, I would say that we are still hovering around this 4.2 plus level. We think ringgit near term still on the weaker side, given the expectation of higher interest rate high in the US side, and also as I said, I think investors would like to see how sustainable Malaysian economy going forward. Most important, there are some key macro indicator which Malaysia will have to show that they are convinced to fix their budget deficit, control their debt level. At the same time, the central bank will have to manage the risk between inflation and also ensuring Malaysian economy continue to recover. And lastly, on the foreign reserve, our foreign reserve level has increased higher compared to year 2020, but partly because of the the special drawing rights, about 5 billion from there. Now, on the property sector, you look at the Malaysian property sector prior to the pandemic had already on the state of consolidation on the downside. Yeah, you look at the average house price index has increased, but in terms of the growth, house price index as measured by the house price index is still increased, but the rate of increase has significantly slowed down. Yeah, has slowed down significantly from 13.4% in the year 2012. Now up to the fourth quarter of last year, it had contracted 0.4%. Yeah, so if you look at overall, 8 consecutive years of the house price index has moderated. So if you look at by house type, you have the high rise that show still struggling house price index, semi-detached and also detached. Yeah, detached. And in terms of states, the one that really experienced a sharp moderation in the house price index will be Kuala Lumpur and also Penang. So and Selangor is still has shown increase, whereas and so the Johor. Yeah. So and I like to share with you in terms of what's the impact on individual and business during the pandemic, during the 2020 pandemic crisis. Because of the higher threshold for bankruptcy, that helped to contain the new bankruptcy and winding up cases. So we can see here the company compulsory winding up statistic. That is based on 2021 up to first 9 months of this year, and also company voluntary winding up statistics. So all these numbers, and also the AKPK, that's the the counseling agency, yeah, the one by the Bank Negara, debt management program. We saw the number, yes, in 2020, like for this AKPK debt management program, in terms of the approval for the year has shown an increase. But if you compare to those company side, in fact, they were lower, and for the compulsory side has somewhat increased. So I think that partly because reflected due to the supported by the temporary measures for reducing the COVID impact, which the government raised the minimum debt threshold for the presentation of a bankruptcy petition to 100,000 from 50,000. So this is a short-term gap measures to ease the financial burden of the company and also some of the loan moratorium and loan repayment assistance that also help the business and also the individual. That's why you can see that helped to moderate the impact. Despite that, we saw some increase in the number of people going to debt counseling. Some company may have to wind up, but the number would be much larger, higher if without all this what call short-term gap measures to ease their financial burden. Okay, so you look at the individual bankruptcy cases also compared to year 2020, it's about 8,000. In fact, it's lower than 2019, and 2021 shows some improvement, and up to February now it's about even lower. So all this could be due to all these contingency measures, measures to contain the rise in bankruptcy and winding cases. So all this has now become entrenched and more made permanent under, if you look at the 100,000 bankruptcy threshold, has now become entrenched or made permanent under the amendment made to Section 5, which came into force on 1st September 2021. Yeah. So during high inflation era, how do we as the individual financial planner, how to protect your saving and asset? So there are a few asset class protection against rising inflation. The first one, which I think most popular among our ladies, is gold, and then I think jewelries. So it's a proven long-term hedge against inflation. You can protect against potentially excessive asset price inflation and currency debasement. So this is the real physical asset and tends to hold its value for the most part, during this high inflation cycle. The other one is a balanced portfolio of stock and bond. I think it's safe traditional mix of stocks and bond in a conservative portfolio as an investor. And stock can be good as long-term inflation hedge, but can suffer in the short term if inflation spike. So there is more the cost of capital rises that will impact on the let's say for example the company listed in the stock market, they have borrowed a lot, and the rising inflation, which means that central bank will raise interest rate, the cost of capital rises, so they need to pay more interest expenses. Hence, the share price will be lower, less attractive for investors to buy. So I think short-term bonds will be more resilient. And digital asset is something that increasingly popular refuge for inflation investor protection. But because of the limited supply, and it helped to protect the digital asset from devaluation compared to traditional fiat currency. So this is something a digital asset like crypto currency, crypto asset. I think investors have to be mindful. They have to have good knowledge, ample knowledge, listen to advisors who are in this area, whether to put their money into invest in all this digital asset, because for Malaysia Central Bank, we don't it's not a legal tender. It's not a legal tender, but though it's not a legal tender, but I believe there are a lot of people still putting their money into digital asset. Hence, I think they need to have a very good knowledge, understand before they commit their investment. On the real estate, traditionally does well during period of high inflation, as the value of property can increase. You can even earn a higher rental income over time. So assuming that economy is doing well, at the same time you have this risk of asset inflation, which means central bank will have to raise interest rate. At the same time, if you are a long-term investor of what call real estate, in general, it really protects your protects your value of money, yeah, provided you invest and buy in the right location. Okay, of course there are cases where you buy property, it does not appreciate. In fact, it continue when go down. So it's again depends on how you do your homework and do the right investment in real asset. I'm not asking you to like continue to leverage up to buy asset, but you also to measure against your ability to service your loan. So maybe you buy your first one and your first asset has give you a good buffer of gain, and then you may consider to invest a second one. So this is how you do your planning and financial planning and manage your different portfolio asset, whether it's a gold, stock, bond, digital, and real estate. Yeah. So what happens when interest rate is rising? I think we have two here. During low interest rate, at the current level, because of recession, because of economy has been damaged by the pandemic, central bank has low interest rate, and worldwide we can see interest rate has remained quite low for quite some time, almost coming to 3 years now. So the low borrowing cost for the borrower is a form of monetary stimulus. Why? Because you need to keep the cost of borrowing low so that you can help the economy to recover, right? Spur consumption, spur demand for investment. People, because of low interest rate, they can afford to buy, they borrow money. At the same time, the servicing will be lower. But there's a risk. If you continue to keep interest rate low, as the economy started to recover, then they will encourage more people to continue to borrow, and that will cause a major financial imbalances, excessive cheap credit, and people will incur more loan, more debt. And Malaysia now, we are in a high debt, high consumer debt. So I think central bank will have to balance, when the economy is going on the path of steady recovery, and more so with the inflation risk, there is a case for central bank to start thinking how to slowly increase interest rate. Yeah. And for
sorry, just to remind you, another 4 minutes left for your session.
Yeah, no problem. Okay. For the lenders, in terms of the low cost of funds, means the bank will see better returns when the funds are used for loans to borrowers. And hence, it will help to lend banks, when the low interest rate, bank can spur the loan demand, and bank also need to look for higher returns to increase their investment income. Yeah. So when the interest rate is rising, for the borrowers, it's something like when the economy is better now, you don't need to give extra stimulus. Yeah. So you have to start withdraw all your liquidity support, and the interest will start to go up. So this is a cooling from the expansionary monetary approach. So then the borrower will have to prepare for higher interest. I mean, they have to pay more, then that will be give up more their cash flow. And there's something what I call asset price correction may happen if the interest rate rise faster, a bigger quantum as what the market expect. So it's between your risk-free rate versus your cost of capital. Risk-free, when the interest rate, the safe rate go higher, as an investor, as a borrower, you may consider less inclined to put money into high-risk asset. Then you put more money into your FD, yeah, into your safe asset to earn the higher interest. Yeah. So the lender side is a vice versa. When the costs are higher, the banks can still pass through, because the next interest, they want to preserve their net interest spread. They will pass through the borrower, which means that the borrower has to pay higher interest rate to access credit. And some borrower may start to or lender will also, bank will offer some refinancing or restructuring loan package. Now the last three, which I will share with you, what are the reforms beyond pandemic? I think, as I mentioned, Malaysia must take the opportunity to reform, to enhance economic and financial resilience for future shock. So we must prepare for future shock. The shock can be economic, financial, can be non-economic, like health, pandemic, geopolitical tension, and climate change. I think most importantly, we must look at what are the current structural issues that we are facing, the constraint, and we have to start recalibrate and undertake politically feasible reform to deliver a more inclusive, resilient, and sustainable future. The first one, which I already highlighted, you must build a leaner government and rebuild public saving. Our fiscal space is very constrained to go for another to safeguard against a future shock. So we have to look at expenditure, operating, even expenditure must closely scrutinize to make sure they are productive. We have to look at the targeted fuel subsidy and cash assistance program, because as you continue to incur unsustainable deficit and public debt, that would have negative impact on the household saving and private investment. And second one is the tax reform. The tax reform, we can do a small step or a big bang. I think given the recovery is still uneven, is better to introduce a small step, a gradual approach on the tax reform. Most importantly, the principle, the objective of the tax system must reward greater work efforts and productivity. I think it's time for government to think about going towards a broad-based consumption tax like GST. I think that is the political view, and I think as the economy is recovering, we can consider to introduce at a very small rate, between 3 to 4% GST. And the third one is to reduce compliance and regulatory costs. These are matters a lot for investment. We need to create a very competitive investment climate. We have to ensure policy certainty, transparent and good governance. Too many taxes and regulatory and compliance costs will real costs and discourage reinvestment activity. And we have to reform regulation with high compliance costs, not simply by reducing the number of regulation. Now, on gaps in the education sector, pandemic exposed the weakness of the current education sector in terms of online delivery. So we need to enhance. We also have to enhance the manpower quality to better enhancement of the TVET. On the healthcare sector, yes, we have spent about 4.7% of GDP in public expenditure. That's not enough. So we need to think about how to priority our budget expenditure to give more allocation to support the better universal healthcare system must be given the priority. And the priority is that you must have a system which is a leaner, efficient, and capable healthcare administrative structure to ensure everyone access to the better quality of and affordable healthcare services. And also in terms of the gaps in social protection system, this is something that we have to be mindful. I think you look at Malaysia, a lot of social system numbers, about 95 in 2012 to about 137 in 2020. So I think it's a lot of fragmentation, duplication. We have to streamline, better targeting, and strengthen the administrative mechanism and ensure effective delivery of the social assistance program protection to the needy group, to the most vulnerable one. Yeah, you have to be targeted and ensure that the limited resources are used in a more productive manner. Now, on the aged care reforms and retirement saving, I think the statistics tell you that 10.3% Malaysia age 60, in 2020. And we also have this potential retirement crisis. So hence the government need to look into how to prepare themselves for aging society, because as your population get more age, right, you impact on labor participation, productivity, you will have impact on the fiscal budget, the healthcare expenses, social expenses, and also the revenue implication. So we need to look into all this about how to address the aged population and also address the retirement saving crisis, a proper financial planning awareness. So we hope this e-conference, Sharia conference in future will continue to educate people how to have a better planning and for their better retirement investment financial product. Now, agriculture and rural farming. This is a sector which we are lagging behind. We should reset it to make sure that we have not just for food security, but also to have a supply of enough imports to reduce how Malaysia high import dependency. So one area which we propose to government is to look at the land reform, to have a longer land leasing to improve the efficiency of land allocation, and also look into areas where we can improve the logistic delivery system to ensure the whole supply chain, when the food reach the consumer, it will be affordable, but not compromising on the quality. And lastly, for a greener greener country, a greener environment, we have to invest in sustainable future. Yeah, because of the increasing trade complexity, climate change, healthcare, and aging population, Malaysia have to move faster on digitalization, technology, and automation, must go towards green investment, ESG. Yeah, it is a must for all companies, regardless of size, and that needed a long-term mindset change with the support of the government in the form of incentive facilitation, especially to support the embrace of the ESG by the small and the SME. So with that, I conclude my presentation, and thank you very much.